Hello and welcome to The Upside. I'm Jordan Chevalier. Earlier this week, the Bank of Canada and the U.S. Federal Reserve held interest rates. And while rate holds were largely expected, external factors such as rising energy prices, inflation, and geopolitical uncertainty remain top of mind for many investors. Joining me today is institutional portfolio manager and member of Fidelity's global asset allocation team, Ilan Kolet. He's here to take us through how these factors are shaping the Canadian and U.S. interest rate stories. Ilan, it's great to see you.
Yeah, very nice to see you as well. Looking forward to the chat.
So as I mentioned in the intro there, I think this time last year, investors specifically, were a little bit less certain in terms of how these rate cuts would position themselves. There was talks of, is it going to be a 50 basis point cut, maybe even a 75? This time it seems like, okay, the rates themselves were expected to be held, at 2.25 here in Canada, but everything else around the interest rate story seems a little more uncertain. So can you take us through sort of these factors that I mentioned and how they're shaping things?
Yeah, sure. That's a great place to start.
Okay.
I mean, it is a very different environment than we were in a year ago, a year and a half ago. Right. And it's different in Canada versus the US as well, right? So taking it one by one, in Canada, we had a lot of rate cuts early on, right? The rate cuts were front loaded, and that was because of the risks, the downside risks to global trade policy that was much more negative for Canada, right? Mm-hmm. So a year ago, April of last year, we were fresh off the April Bank of Canada monetary policy report where they talked about two scenarios for tariffs. One of them was absolutely disastrous. One of them was, I would say, less negative, but still pretty negative. Mm-hmm. And so the Bank of Canada front-loaded rate cuts, which was the right move to do. The way I think about rate cuts and the way I think investors should be thinking about the direction of rates is to uncomplicate things, right? Things in general, I would say our industry overcomplicates the rate cut decision.
Okay.
And the way I would say we should think about it is handcuff yourself to two variables, the inflation rate and the unemployment rate, and where those variables have been, where they are now, and where they're likely heading. So for inflation in Canada, inflation was very low pre-pandemic. It got very, very high. And now inflation is roughly in line with where the Bank of Canada would like to see it. That suggests don't do anything.
Okay.
On the unemployment side, unemployment is a little bit elevated in Canada, sitting in like the mid sixes right now. It's off its peak, but it could be lower. The reason the Bank of Canada took a wait and see approach this week was because of the balance of risks, right? So the balance of risks, what that means is there's really a balancing act of risks. On the downside, we don't know how USMCA CUSMA negotiations are going to go. If those are exceptionally negative, you could see an easing in the policy rate. And on the other side, we have the Iran war, which has boosted energy prices, which has flowed through to gasoline prices. Depending on how long those energy prices stay elevated, that could leak into or feed into or fuel other increases in other parts of the inflation basket. That's where things get complicated, right? If we start to see generalized inflation on the things that require being shipped to Costco or right. to the grocery store, then that means the Bank of Canada would have to potentially take meaningful action against a generalized increase in inflation. They don't want to do that. They'd love to not do that, but they have to sort of stand ready. On the Fed side, I'll just take a couple minutes there.
Yeah, please.
On the Fed side, it's a pretty different story. On the Fed side, rates are higher. They haven't cut nearly as much as the Bank of Canada did, and that was the right approach because inflation has subsided a lot. Again, thinking about just inflation and the labor market, inflation has subsided a lot. It's not exactly where the Fed would like it to be, right? Which means don't do anything. Remain somewhat restrictive to push that inflation rate lower. And then on the labor market side, the US labor market is, I would call it fine, right? It's not on fire and it's not a mess. It's generally fine. I would say it's stable or reasonably strong. The bigger issue in the US is political interference with the Federal Reserve, right? And that is why they've had to be very, very careful about further rate cuts. And that's why Chair Powell this week specified in a pretty unusual, unprecedented move that he would stay on longer to make sure that political interference is completely put to bed.
So there's a stability question there looking at the US, and you think that Chair Powell staying on, at least as governor, right, will sort of stabilize a little bit of that?
Yeah,
That's
so
the hope. Yeah.
Exactly. So Chair Powell staying on as chair, I mean, when people ask me like what keeps me up at night,
Right.
it's political interference with the Federal Reserve, right? So we should not underestimate how serious and damaging this potentially could be. And why is that the case? Well, central governments, right, think, fiscal policy at a federal level, at a government level, inherently wants to run an economy hot, right? That means, tax cuts or fiscal spending. That results in a tighter labor market, the unemployment rate pushing lower. When the unemployment rate pushes lower, how do you hire the person from across the street? You pay them more. That pushes up wage growth, that pushes up service inflation, that pushes up inflation. And then as inflation starts to cook, it's very momentum driven, as we've learned, the Federal Reserve or the Banque du Canada or any credible central bank comes in and says, whoa, not so fast, folks. We're going to raise rates and cool things down. If you have a politically captured Fed, if the government has its boot on the neck of the Federal Reserve, and they say, no, don't raise rates just yet, it's transitory, right, which is like a swear word now,
Right.
Then you run the risk of elevated inflation. And that's what we're concerned about in the context of our funds, is higher inflation and higher inflation volatility.
Are there specific, and you mentioned a little bit the conflict in the Middle East, are there specific concerns there if prices continue to rise? And it seems like negotiations are in an on again, off again situation. Things are a little bit unclear. How do those geopolitical risks, or are there other things that you're looking at ahead of how things are shaping right over in the Middle East? Yeah.
Yeah, I mean, so the way that we manage our funds is, I think it's important to know what our edge is and what our edge isn't, right?
Okay.
So the advisors from coast to coast, the thousands of advisors that use our funds, the millions of investors that use our funds to save for retirement or education, et cetera, I don't think any of them believe that we have an edge on predicting the moment the Strait of Hormuz is going to be open, right? Not to be facetious about it, but that is not our edge. Our edge is not in forecasting the likely outcome of geopolitical events and then pre-positioning for it and then hoping asset classes move in certain ways based on what we think might happen. I mean, the way I think about geopolitical risk is we manage through geopolitical risk, not for geopolitical risk. And if you look at our results at a very long-term horizon, right, I think 15 years, right, we've beaten more than 90% of peers. We have very strong performance at that very long-term horizon. And the other thing I like to say is, over the last 15 years, there's been plenty of geopolitical events, right? So we're focused on the one that's front and center, but not that long ago, we've had other ones, right? We've had a whole host of them. We really need to stick to our 4-pillar, strong research-based investment process, which is based on the macro, the bottom-up, sentiment, and valuation. We need to lean on the spectacular group of researchers that we work with closely. And then we need to add 1 basis point to the mountain, 1 basis point at a time, so that our clients build wealth slowly.
And is that something, if investors are watching this and they're thinking, well, that sounds like a great way to structure broader portfolios right within their own sphere. If energy prices continue to climb, and we've seen this $200 US a barrel pricing, if things do continue to climb, are there things there that investors should be looking at as those prices continue to get higher? Yeah,
and it's interesting. So you mentioned $200 a barrel oil. I think there was actually inflation in the forecast. Then I saw someone with 250 and 300, right? So who can have the most spectacular inflation or oil price forecast is going to get that headline. And I spent time at a large news agency. So when someone says $250 a barrel oil, you have to put that out as a story. So one of the reasons our portfolios that we manage for Canadian investors, so we're managing about $115 billion in multi-asset class funds for Canadian investors. One of the reasons that they are so effective is they are an elegant and simple solution to a set of really complex problems. Right? So I'm concerned about geopolitical risk and inflation being more volatile and pushing higher. How can I protect against that? The answer is, in the portfolios that we're managing, we own asset classes that protect the portfolios against some of these risks, right? So top of the list for me is gold, right? So we've owned gold for a long time. We own a small amount of it, roughly 2%, call it, in an ETF holding. But gold is one of those asset classes that, again, performance we've benefited from pretty significantly, but it protects against geopolitical risk. It protects against inflation and inflation volatility. It protects against US dollar depreciation and debasement. So what we want to do is have protection, protection built into the portfolios from a number of different perspectives, right? From an asset class perspective, as well as a manager perspective, right, so that the end ride for the end investor is smoother, right? So we always think about, it's a bit nerdy, but we think about things in risk-adjusted return, right? Not return, risk-adjusted return, meaning it's not just the return that matters, it's the ride the investor is receiving in achieving that return that matters as well. So when someone says, I'm concerned about oil prices, how should I protect against them? The answer is that's being done for you in the managed portfolios, the private investment pools. So certainly speak to your advisor about that in a number of different ways throughout the portfolio, in terms of asset classes.
Ilan, before we go, is there something that you want to just, leave investors with who maybe be looking at the headlines, right, seeing a little bit of uncertainty here, seeing prices rise? Mm-hmm. What would you say just sort of generally to them, before we go? Yeah, so
again, you know this, Jordan, as well as I do. Bad news is what makes headlines, right? And I don't think that this is the type of environment where being over your skis in terms of risk is the right approach, right? So in the context of our portfolios, we are slightly overweight equities, but slightly compared to the prior years when we had a larger lean in to equities. We're cautiously optimistic on Canada. We just put out a paper, as you know, a couple of weeks ago called Conflict Favors Commodities in Canada. I would welcome everyone to read it and check it out. And in that paper, we discussed the thesis that if we are in a world of the higher likelihood of supply shocks, mm-hmm, right? Think an oil price shock or less globalization or less trade. That means higher inflation and higher inflation volatility, which means you need to own the asset class that protects your portfolios against it. Think commodities, which then means this is the case for Canada, right? Sure. Roughly 40% of the Canadian market is energy extractors and resource companies. So we have a higher beta or sensitivity to commodities, right? And right now we're cautiously optimistic, I would say. We're leaning into Canada specifically for these reasons. And it'll be interesting to see how that evolves.
Ilan, thank you so much for being here.
Yeah, thanks so much, Jordan.
And thank you all for watching. Just a reminder that Upside webcasts air daily, so keep an eye in your inbox to receive your invitation to the next show. And do sign up for the Upside newsletter to receive the latest updates. Also, video podcasts are released frequently, both the Upside and Fidelity Connects. Just search Fidelity Canada on YouTube, Spotify, and Apple Podcasts. And the latest global asset allocation paper authored by Ilan here and his team is available on fidelity.ca. Thanks again for watching. I hope you'll join us next time on The Upside.
Thanks for listening to, or watching, Fidelity Canada's The Upside podcast. Subscribe on your podcast platform of choice so you don't miss an episode. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on LinkedIn, YouTube, Instagram, or X. We'll wrap things up today with a quick disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.